Welcome back to Investing Talk Podcast.
Today we're looking at DVLT AI. The big question is it a good time to buy now?
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, we've looked through all the sources on DVLT AI, and wow, the first thing that jumps out is just this incredible acceleration in how investors are feeling.
Yeah, massive volatility recently.
But this time it feels different, like it's tied to actual company moves, not just, speculation.
Right.
Let's maybe unpack what happened over the last, 3 months? September to November 2025 specifically.
Well, what's interesting is how reactive the surge was. It wasn't just hype. It seems like a direct response to some pretty crucial fixes, both financially and operationally.
Okay, so what was the main trigger?
Capital. Definitely capital first. They managed to secure the first tranche, the first part of a planned $150 million strategic investment.
Wow, okay. $150 million planned. That's a serious injection. Suggests some real belief in the long game.
It absolutely validates the vision, yeah. But getting that money wasn't the only fix, right? They tackled a big liability, too.
The debt conversion.
Exactly. They pushed through the conversion of about $13.3 million in convertible debt. Now, for anyone listening, turning debt into equity like that, it's a major cleanup.
Right. It takes a big chunk of debt right off the books, makes the balance sheet look immediately stronger, less leveraged.
Precisely. It significantly lowers their risk profile, at least on paper.
And the market just ate it up. That stock surge, what was it, around 623% from the September lows, hit $2.46.
Yeah, explosive reaction. That kind of move gets everyone's attention. But it was underpinned by something else really important, something stabilizing.
The Nasdaq compliance.
Stability is the perfect word. They got back into full Nasdaq compliance, hitting that minimum bid price. For a lot of institutional funds, that's huge.
Because they have mandates, right? They can often only invest in fully listed compliant stocks.
Exactly. It removes a major hurdle. Suddenly, new pools of investors can potentially come in. It elevates them from maybe being seen as a speculative play to a more serious listing.
Okay, so financial cleanup, compliance sorted. But the sources also mention some key strategic moves that show they're thinking bigger picture about innovation.
Yeah, and not small moves either. IBM committing 20,000 engineering hours. That's not pocket change. It's serious technical expertise being pointed directly at DVLT AI's products.
That kind of contribution, especially from IBM, suggests they see something genuinely unique there, some tech worth investing time in.
You'd think so. And then there's the physical move, shifting headquarters to downtown Philadelphia. That's strategic too.
How so? Closer to talent.
Talent, yes, but also major universities, other tech companies, venture capital. They're embedding themselves in an ecosystem. It's smart positioning.
Makes sense. It's all about fostering those connections for growth, which kind of leads into this data union thing they're pushing.
Right, another ecosystem play. Trying to build a network, encourage data sharing between partners, make their platform stickier.
And we're already seeing some big names notice. JP Chase disclosed owning, nearly 280,000 shares?
Yeah, 278,028 shares reported in their latest filings. That's significant external validation.
So if you pull back, the picture is a company that just pulled off a major financial and compliance turnaround, started attracting big institutional interest, and secured high-level tech partnerships.
That's the narrative, yes. A flurry of positive developments.
It sounds almost too perfect. When a stock jumps over 600% that fast, you have to wonder if the underlying business fundamentals have caught up yet. What does the actual balance sheet look like if we put the hype aside for a second?
Good question. We need to, check the engine. On the growth side, things look pretty decent for a company this size. 2024 revenue growth was solid, 28.4%, hitting $2.67 million.
That's faster than a lot of other small AI companies, right?
It is, yeah. It outpaces many microcap AI peers. And importantly, their gross margin, while not huge, is positive 12.4%. So they are making money on what they sell, just not enough yet overall.
And that performance seems to be reflected in how analysts see it. Consensus is a strong buy. That's quite bullish for a micro-cap.
It is. And they've put a 12-month price target of $3 on it, which from current levels implies, around 77.5% upside?
Huge potential upside. Clearly, the market believes there's something special about the core tech.
Well, the belief really comes from their claimed moat. We should probably try and make that concrete for people listening.
Okay, so what is it exactly? High-performance computing, data management.
Yes, but the focus is the key. It's heavily centered on data ownership, privacy, and using supercomputing power. especially for regulated industries.
Regulated industries like banks, hospitals.
Exactly. Think about finance or healthcare.
Hmm.
They have tons of sensitive data, personally identifiable information, PII. They can't just upload all that customer data to some generic cloud platform for AI training because of strict rules.
Right. Huge privacy and compliance risks.
Precisely. DataVault AI's pitch is that their platform lets these companies train AI models on their sensitive data without actually moving the data or exposing the raw private info. That specific capability, using the data without exposing it, that's their core value proposition. That's the moat.
Okay, that makes it sound much less generic. That's a real problem they're solving. But let's pivot to the big elephant in the room, profitability, or rather, the lack of it. Growth is one thing, but they're losing a lot of money, aren't they?
Yeah, this is the critical risk factor you absolutely have to confront. The latest annual net income was deep in the red, negative $67.73 million.
Ouch! That's significant.
It reflects that aggressive spending on R&D and expansion needed to build that moat we just talked about. But yeah, it signals a massive cash burn. The latest quarterly EPS was also negative $0.54 on revenue of only $1.74 million.
So spending way more than they're making right now. And looking at liquidity, that paints a concerning picture too, doesn't it? The current ratio.
It's tight. The current ratio is 0.5. Now, for listeners tracking this stuff, a current ratio of 1.0 is generally seen as the baseline for stability.
And 0.5 means?
It means for every dollar they owe in the short term, think bills, payroll, due, soon sound, they only have about 50 cents in easily accessible assets to cover it.
So they're really leaning on that new investment cash to keep things running day to day.
Heavily, yes. Their overall debt leverage is actually manageable, around 1.6, but that low current ratio really highlights the working capital strain. It underscores the execution risk. They need things to go right.
Okay, so given that risk, given the cash burn, when do we get more clarity? Are there specific things investors should be watching over the next, say, 3 months that could signal whether they're actually turning the corner towards profit?
Definitely. There are a few key dates and events coming up. First, circle December 6, 2025 on your calendar. That's when their Q3 2025 earnings report is due.
And what will the market be looking for there?
Improvement in cash management, obviously. Signs the burn rate is slowing. And maybe, hopefully, some updated, more positive projections now that they have that new capital.
Okay, earnings are key. And you mentioned Nasdaq compliance earlier. There's an event linked to that coming up too, isn't there? Something about ETFs?
Right. On December 20th, 2025, there's a major ETF index rebalancing. Now that they're fully compliant again, index funds and ETFs that track various small-cap indices might be required, or at least allowed, to buy the stock.
Ah, so potential forced buying. Passive flows coming in.
Could be. It could definitely increase buying pressure and improve the stock's trading volume and liquidity, which would be welcome.
Makes sense. What about seeing who else is jumping in? We know JP Morgan's in, but are other big institutions following?
We should get a clearer picture on that in early January 2026. That's when the next round of institutional 13F filings comes out.
Remind us what those are.
Sure. 13Fs are quarterly reports where large investment managers, those managing over $100 million, have to disclose their holdings. So we'll see who bought or sold DataVault AI in the previous quarter. It'll show if that recent momentum attracted other big players.
Gives you a sense of longer-term institutional confidence. Okay. And there was one more, slightly odder catalyst mentioned. Something about a meme coin.
Yes. The distribution of the Dream Bowl draft meme coin on November 14th. Well, it's a reminder that alongside their serious enterprise data business, they're still playing around the edges of the crypto world. Adds a bit of speculative flavor, maybe.
Definitely speaks to the risk appetite maybe associated with the stock. And speaking of speculation, the sources mentioned persistent buzz about more expansion, M&A activity.
Yeah, they seem to be aggressively looking to grow. We know they have letters of intent out to acquire MYIAX, just some kind of financial platform. And the rumor mill keeps churning about other potential M&A targets.
Acquisitions can accelerate growth fast, sure, but they also crank up the execution risk and, importantly, the cash burn we just talked about.
Absolutely, it's a double-edged sword.
Any sense of where else the M&A focus might be?
Well, it ties into those persistent rumors about high-profile partnerships, especially connected to that data union initiative. There's a lot of chatter about potential links in the Eurozone fintech space.
Oh, like who?
Specifically, there's been speculation connecting them to the Swiss exchange. Now, if they actually landed a partnership with the Swiss exchange, that would be a massive credibility boost, especially in regulated finance globally.
That would be a game changer. Okay, anything else on the speculative front? Tokenization, NFTs.
Yeah, there's some talk about maybe rolling out more advanced tokenization or NFT features,
Mm.
possibly tied to their data exchange platform, and perhaps accelerated by the move to that tech hub in Philadelphia.
Yeah,
Still very speculative, though.
got it. Okay, let's shift gears slightly to the technicals. What are the charts telling us right now? Does the price action support this bullish narrative?
Broadly, yes. The price currently is around $1.36. And significantly, it's trading above both its 50-day moving average, that's at $1.37, and its 200-day average, which is down at 93 cents.
And trading above those longer-term averages usually signals.
It confirms the underlying trend strength is definitely bullish right now. The momentum is positive.
So where are the key levels traders are watching? Support and resistance. Where does it need to break through to keep running towards that $3 NLS target?
It looks like there's pretty solid support established between $1.20 and $1 banana third. Buyers seem to step in around there. On the upside, the next major hurdle, the resistance zone, is roughly $1.70 up to $2.
So breaking $2 is the key.
A clean break above $2, yeah. And that would likely be needed for the next leg up for real acceleration. And this momentum isn't just price, it's volume too. We saw huge trading volume recently, like 33.3 million shares, which is almost 60% above its average. Strong accumulation.
Okay, volume confirms the move. What about the human element? Insider activity, more institutional buying.
Well, we know institutional money is starting to come in. Synergy Asset Management, for example, just started a new position, picking up over 122,000 shares. A positive sign.
But insider activity, is that as uniformly positive?
That's where it gets a bit mixed, actually, and this is important. Insiders as a group hold a decent chunk, about 7.7%, so they definitely have skin in the game.
But there was a specific sale recently, just before the big run-up.
Yes, and this raises eyebrows. Recent Form 4 filings, those track insider buys and sells, showed that one insider, Brett Moyer, sold quite a few shares, over 130,000, in late August 2025.
Late August. That was right before this whole 600% surge kicked off.
Exactly. The timing looks
Yeah.
interesting. It could just be diversification, personal financial planning, who knows? Or maybe it suggests he wasn't expecting such a dramatic turnaround quite so soon.
Or maybe just unlucky timing for him. But it does add a note of caution, doesn't it?
It absolutely does. It happened before the price spike, so it's not like he dumped at the top. But yeah, it's a data point that tells you insider sentiment maybe isn't 100% aligned or confident across the board. Definitely something to be aware of.
Oh, a bit of a red flag to keep monitoring. Okay, so wrapping this all together, the final kind of overarching risk seems to be execution, right? Given how fast they're trying to expand, the M&A appetite, the R&D spend, that tight current ratio.
Right.
It all comes down to whether they can actually deliver profitable growth.
That is the absolute crux of it. Can they successfully monetize that proprietary tech moat before the cash runs out?
So weighing it all up, the bullish case versus the risks.
Well, you have this huge long-term potential, clearly, driven by what seems like genuinely innovative tech, now backed by serious capital. That's very compelling. But you have to balance that against significant scaling risks and that very real liquidity pressure.
So maybe different plays for different investors?
I think so. If you're looking long-term, you need a lot of patience. You need to wait for those profit margins to actually improve, which could take time. But with all these short-term catalysts lined up, earnings, index rebalancing, potential partnership news, there are undeniable opportunities for shorter-term momentum traders right now. The volatility creates chances.
So the core tension really is, can DataVault AI protect its vault of unique tech while managing this incredibly aggressive expansion and cash burn? You know, you see companies fail not because the tech was bad, but because they tried to grow too fast, spent too much too soon. With all the M&A talk and rapid moves, you have to ask yourself, are they pacing themselves for a marathon or are they sprinting right out of the gate?